Welcome back to Money Talks, Finance for All, the podcast dedicated to demystifying the world of finance and making it accessible to everyone. I'm your host, Alex, and today we're diving into a classic that has shaped how millions approach investing. A Random Walk Down Wall Street by Burton G. Malkiel. This book has been a cornerstone of personal finance for decades, and its insights are just as relevant today. So, grab your headphones and let's get started. A Random Walk Down Wall Street, first published in 1973 and regularly updated, argues that attempting to beat the market is, for most investors, a fool's errand. Malkiel, a Princeton economist, presents a compelling case for a passive investment strategy, emphasizing the importance of diversification and low-cost index funds. This book isn't about getting rich quick. It's about building long-term wealth through a disciplined, evidence-based approach. In today's world of complex financial products and volatile markets, Malkiel's message of simplicity and sound financial principles is more important than ever. On Money Talks, we believe that everyone deserves access to sound financial advice, and understanding Malkiel's work is crucial for navigating the world of investing. At the heart of Malkiel's argument lies the efficient market hypothesis, EMH. This theory suggests that all publicly available information is already reflected in stock prices. In essence, trying to find undervalued stocks is like trying to find a $20 bill lying on the sidewalk. Someone would have already picked it up. This leads to the random walk theory, which proposes that stock price movements are unpredictable, like a random walk. Imagine a drunkard stumbling down the street. You can't predict where his next step will be. Similarly, Malkiel argues that past stock performance is not a reliable predictor of future returns. Another crucial concept is diversification. Malkiel stresses the importance of not putting all your eggs in one basket. By spreading your investments across various asset classes, such as stocks, bonds, and real estate, you reduce the risk of significant losses. If one investment performs poorly, others may offset the losses. Malkiel also delves into behavioral finance, acknowledging that investors are not always rational. Emotions like fear and greed often drive investment decisions, leading to costly mistakes. For example, during market booms, investors often experience FOMO, fear of missing out, and buy stocks at inflated prices, only to sell them at a loss when the market corrects. This herd mentality is a prime example of how psychology can derail even the best-laid investment plans. Think of the dot-com bubble or the housing crisis. These are classic examples of market manias driven by irrational exuberance. Based on these concepts, Malkiel advocates for a passive investment strategy centered around index investing. Index funds are designed to track a specific market index, such as the S&P 500, providing broad market exposure at a low cost. Instead of trying to pick individual stocks, you're essentially buying a slice of the entire market. Mutual funds and ETFs, exchange-traded funds, are the primary vehicles for index investing. ETFs, in particular, offer flexibility and low expense ratios, making them attractive to individual investors. Malkiel also emphasizes the importance of asset allocation, which involves determining the appropriate mix of asset classes based on your risk tolerance and investment goals. A younger investor with a longer time horizon might allocate a larger portion of their portfolio to stocks, while an older investor nearing retirement might opt for a more conservative mix of bonds and cash. The key is to create a diversified portfolio that aligns with your individual circumstances. While A Random Walk Down Wall Street has been highly influential, it hasn't escaped criticism. Some argue that the EMH is too simplistic and doesn't fully account for market anomalies or the ability of some skilled investors to consistently outperform the market. For instance, value investing, popularized by Benjamin Graham and Warren Buffett, suggests that identifying undervalued companies can lead to above-average returns. Critics also point to instances where active fund managers have outperformed market indices, particularly in certain market segments. However, Malkiel argues that consistently identifying these managers beforehand is extremely difficult, and the high fees charged by active managers often erode any potential outperformance. Furthermore, the vast majority of active managers fail to beat the market over the long term. While there are exceptions, the evidence strongly supports Malkiel's argument for passive investing as a more reliable strategy for most investors. So, what are the key takeaways for our listeners? First, embrace the power of long-term investing. Don't try to time the market. Instead, focus on building a diversified portfolio and holding it for the long haul. Second, keep your costs low. Choose low-cost index funds and ETFs to minimize expenses, which can significantly impact your returns over time. Third, rebalance your portfolio regularly to maintain your desired asset allocation. As market conditions change, your portfolio may drift away from your target allocation, requiring adjustments. Finally, don't let emotions drive your investment decisions. Stick to your plan, even during market downturns. Remember, market volatility is normal, and trying to predict short-term market movements is a losing game. A Random Walk Down Wall Street provides a valuable framework for understanding the principles of sound investing. Malkiel's emphasis on passive investing, diversification, and low costs offers a practical and effective approach for building long-term wealth. We hope this episode has given you some food for thought about your own financial journey. Remember, on Money Talks, we're here to empower you with the knowledge you need to make informed financial decisions. For more resources on this topic, you can explore past episodes. And before you go, don't forget to subscribe to our channel for more insightful discussions on personal finance. We'd also love to hear your thoughts on this episode, so leave a comment below and let us know what you think. Until next time, keep those money conversations going, and let's build a financially literate future together.